You want it? We have it. The hottest mortgage and real estate strategy broadcast in the nation. A Smarter Way Home with your host, Danielle Boote and Victor Bals. 50 years combined experience, ranked in the top 1% in the nation for home loan originations 2020. Promise to expand your knowledge, utilizing creative mortgage financing and home buying strategies. Build a bridge for a better quality of life. Get your brain cells firing for a smarter way home. And good afternoon. Welcome to another episode of A Smarter Way Home. Modern mortgage solutions and home buying strategies for real estate professionals and consumers alike. I am your host, Victor Bals, loan officer and host. And I want to introduce to you my hostess with the mostest, my partner in crime, Mrs. Danielle Boote.
Hello, Victor. How are you today?
I'm okay today. I woke up at 1:30 this morning.
Oh, that ain't good.
And turned on the news, and we see a bunch of stuff going on there. We got Russia invading Croatia. The market's going crazy out there.
Ukraine.
Yeah. Oh, yeah. Ukraine.
You picked Wait, let's hope they didn't go there yet.
Well, anyway, and that's kind of a good lead in for our show. But anyway, Danielle, good morning to you.
Good morning. So Ryan is with us today. I'll let you do the introduction so you know him personally. And it's kind of timely that he's here today so that we've got an agenda to discuss, but we may be able to bring in some geopolitical hot topics for the day.
Yes. Well, this is Mr. Ryan Schacht. He is a financial planner right here in Livingston County. I've known this gentleman for 15 years. I used to work with his father when his father started the business, and it's been passed off to Ryan. And I remember one of the things my wife and I talked about is we are never going to take financial advice from someone younger than us, you know. And I remember when you were a rookie and your father brought you into the business.
Yep.
And you sat there like a deer in the headlights.
Yep.
And you learned and you learned and you learned. And now your dad's kind of weaning out of the business. And we treat you like our third son. You know, we trust everything. But Mr. Ryan Schacht,
hello.
How are you?
I'm doing great.
Good. And you got a cast on there. See, would you break your arm? You had a surgery.
No, it's torn labrum and a bicep reattachment. Just been living hard.
Okay. So Ryan, tell us a little bit about you. You're a financial planner, but where did you come from? What do you do? Tell us about your family. What got you to here today?
Yeah. That can be an hour-long podcast if you want it. I'll try to keep it quick.
Okay, go for it.
So, long story short, I joke around with people all the time and say, when did you start in the business? I said, well, I started in 1984. They're like, how is that possible? I said, well, my father started this business 2 weeks before I was born.
Okay.
So we joke around because, you know, just around the dinner table and things, we just always talk about the markets. And to me, it just becomes natural. You know, my wife will say things like, I don't even know what you guys are talking about. You know, like you're speaking Chinese, it seems like. But to my father and I, it just comes out naturally. We just bounce back and forth and ideas. And then, you know, just through the years sitting there and listening to Dad, I developed a passion for it. Even when you're a young kid, you would take, questionnaires like, what are you going to do with your life? Kids want to be policemen, officers, lawyers. Mm-hmm. And all I knew was I wanted to help people with money. Like it always came out in these questionnaires, even as a young kid. Maybe that's influenced by my father, but just going along with him, he would take me to clients' house and I'd see how they would treat him and respect him and how he would respect them and help them with their goals and dreams for their financials. And then from there, the passion just kept growing. Got out of high school. I graduated from Southline High School in 2002, went right over to Western Michigan from 2002 to 2006, got my degree and got right out. And Dad said, on graduation day, you got 2 weeks. I'll see you in the office. Uh-huh. So it started. I walked in the doors on May 15th of 2006, and the rest is history.
Wow. And children?
Yeah, 3. Wyatt, he's 10. Hazel, 7, and Gwen is 3.
Okay. And so you've been in this business, well, since what?
16 years.
16 years.
I'm the oldest young guy, you know.
Yeah, you're the oldest young guy. I know. Okay, so as a financial planner, one of the myths that I hear all the time is, I don't have a lot of money to invest with a financial planner. Set us straight on that. Who needs a financial planner? What is a financial planner?
Ooh. Good question. Who needs one? I, of course, just like anybody would think everybody would need one to a certain degree. But in the beginning, when you're starting out, like a young kid, let's say you're Ryan coming out of college and you don't think you need a financial advisor, I beg to differ. I think you need to talk to someone with some guidance so they can kind of teach you the mistakes they made coming out of school. Maybe they didn't save enough. Maybe they didn't think that they'd be 45 years old in the flash, like you get old quick, and think that it's never going to come is a misconception. And, what they always say, it's time in the market. It's not timing the market. You need to just start being diligent, whether it's $20, $50, $100, make sure you get with your 401k if they have a match out of school and just start saving. It's better to start doing something than nothing, thinking that tomorrow's never going to come, because I could show you a handful of 50-year-olds that come through the door that didn't think they'd turn 50 and don't have enough to retire on effectively and efficiently. So for young people, you just got to get started, but look for guidance, look for proper guidance.
Okay.
Well, I had a kind of a family acquaintance message me on Messenger just last week and said, I have $2,000 in an account and we want to do something with it. What do we do? And she didn't have a family member that really she would trust. Now, she knew I was in the mortgage business. But you look at that and go, well, that's a loaded question. This is somebody in their 30s that is married, that has children, two working adults in the household. And you go, well, first of all, that's not a question, right? I can answer, because they really need to go, look, you have to look at your life situation, where you are, where you plan on going, and go, okay, $2,000 is a place to start potentially, but what are all the other facets that go along with, financial planning and what you're going to do in the future?
No, it's a good point. I mean, so I am a chartered financial consultant. It's a professional designation. I went to Oakland University for a year and a half and then had to get 7 tests to pass it to get that credential for a professional designation. And one of the biggest things I tell you about is talk to the clients of their matters of importance. Mm-hmm. Really sit down and figure out what they want, where they're going, and what their dreams are, and then start working from there. And then our job is to know the rules and regulations of what you can and can't do, and talk to them about, maybe they go into something like a Roth IRA if it's for retirement, because there's income caps. So if they're just starting out, they didn't hit those income caps so they can contribute to a Roth IRA, that's a good start, because that's going to grow tax deferred. And then ultimately 59.5 will be tax free. Take Uncle Sam out of the equation. The way the rules are written right now is that at that point, if that $2,000 turns into $100,000, it's all yours, and you take that ordinary income tax out of the question.
And that's something that what you just touched on regarding the rules with the IRS. That's something, right? At our age, Vic, I can look back and look at all the changes that have occurred with the IRS and how that impacts the the U.S. consumer. And you go, okay, I wouldn't have imagined when I was 18, 19, 20 years old how many tax changes I would see, how broad those changes would be, and how they would really impact me 10, 15, 20 years plus later.
Absolutely.
And that's something that you can't quantify as a young adult, where you go, oh, for instance, the young adults today, they know what a 401k is. My husband's older than I am, and he honestly, in his 35, 40-year career, never worked for a company that gave him a 401k. Wow. And he was in healthcare and management. But he worked for smaller companies that just didn't offer it. So young people today, young people under 30 or 35 don't realize that there was a shift in this country from everybody having a pension. Yep. Okay. Our parents, not so much our grandparents, okay, but our parents, many of them grew up in a generation where you worked for the big three, you had a pension, okay? We now have our generation, and Vic and I are, Vic, you're almost the same age as Jim. You're actually younger than him. But you go, there is a generation that doesn't have a pension. I have never worked for a company that had a pension. I've always had the opportunity for a 401k, even in the years that I couldn't afford to put money away. But, there have been huge shifts. Huge. And if you don't understand, and this I think goes for everything in life, if you don't understand a little bit of history, whether it's geopolitical, it's U.S. history, it's business history, or U.S. tax history, to understand where we are today, where things were 10, 15, 20 years ago, to help you create a roadmap for your future.
and where they're headed. You know, you're talking about
Yes.
defined benefit plans, and you started just making me think of things. My dad's dad worked for Ford as an engineer. He was the guy who had a pension. You give me 30 years, we'll give you 30 years. And life expectancy back then was 65 years old.
Yeah.
Like, Vic, you're like, you know, we don't have to plan for the next 30 years,
Right.
years, because you're not going to be here in the next
Put
5.
it all on red, Ryan.
But that's why, that's why defined benefit plans worked back then, because life expectancy wasn't long.
Right.
But then it become a burden on the companies to keep that promise and paying them. I mean, you heard about the Ford pension buyouts, the GM pension buyouts.
Yeah.
They wanted them off the books. We took a lot of those clients on to recreate that income for them that they had. Right.
Right.
So, like you were saying, there is a big shift. So let's go back. My grandfather lived and died by the defined benefit plan, the pension. Then now my father, he's living and dying by the 401k, defined contribution plan. You know, companies say, hey, here's our 401k plan. Have at it. Good luck. Try
Right.
planning for the next 30 years of your life, you know?
Right. Typically without an advisor.
Yeah.
You know, your company doesn't give you any financial advice.
No.
You as the employee has got to take whatever they give you and whatever fee structure is built in the back end of that 401k, which can be very steep,
Yep.
to try to do something with it. And honestly, where the contribution limits are today, if you don't start saving in your 20s, you don't have a chance to have enough to retire off of.
Well, it's funny. You bring that about the 401k. When you have a company provided 401k, you can go in there and play around and pick some of their options, you know. But me as not a financial planner, not a stock picker, I looked at that and I actually went to Ryan. I said, hey, Ryan, I've got this 401k. It's pretty decent. Can I have your services go in and manage it? You know, and he goes, well, we can't go in and make the picks for, or the actual changes, but here, I'm going to give you my 10 cents on this is the portfolio you should go in with your risk tolerance, you know.
Yeah.
And so we did that for several years.
Yeah, we have programs that help guide clients. Basically, what I say, provide a roadmap. When markets start changing, conditions change. I use a lot of analogies because I figure people remember them. So I always talk about a stovetop and boiling water. Like one of my jobs, like for your 401k through this program, is to continually move the water to keep it boiling around different hotspots. Just like the economy changes, the markets change. You know, for the last 5 years, the USA has been the hotspot, right? But that wasn't the same back in 2002, 2006 when I was at Western Michigan University, and we talked about is the Brazil, Russia, India, China. They were the hotspot. I mean, I could pull up a diversification map and show you there's a year that emerging markets were up 79%, while the U.S. was only up 29%. So,
Right.
you know, we're not there yet, you know, but the things are starting to change. But the point is that we have the guidance. And I joke with people too. You got the butcher, the baker, the candlestick maker. We all have different jobs.
Yeah.
You can do everything, but there's not enough time to do everything, you know?
Right.
Like, look at you guys, you're mortgage specialists. I don't want to tiptoe in here. I'm enough to be kind of dangerous, but I go to Vic and say, hey, what should I be doing? Should I make moves? Yes, hold, wait, you know?
Right.
And then he comes to me and do the same thing.
Yeah, you're the cook in the kitchen, moving the pot of boiling water over to the hot spots.
Yeah, and with what's going on, and you know, lead in with the geopolitical risks that you guys are talking about. The Russia, Ukraine, as we're sitting here, they're invading, and you know, these are those tension points that can. Is it going to be something bigger? Are we going to World War III? Is this a big issue, or is this going to be a sign of a paperwork and a letter and a negotiation deal, and it's over just like that? And
Right.
if you look back at history, more times than not, it isn't going to be a prolonged situation. But is this time different? I'm a financial advisor. I don't have a crystal ball.
Right.
You
Nobody
know,
has a
no
crystal
one-
ball.
So, you know, you got to protect, but, you know, and take advantage of when market's going. You know, we're having a market correction. We're all over 10%. S&P Dow is down 10%. NASDAQ's down off 20%, right? People got pretty easy since COVID came and we revved up the printing machine and the government was giving people money and bringing new investors into the market that have never played before, right?
Yep.
And here's your gambling chips, basically, because the government shut down the casinos, they shut down sports gambling and everything. So off to the casino was the only thing that you
With
had
your,
available with your stimulus.
With your stimulus money. Now, I read a couple articles on that topic.
Yeah.
And the younger population, I think it was 35 and under, took that stimulus money, and there was a huge percentage of this demographic that put the money into the stock market.
Oh, absolutely.
And one would expect, and I guess we'll see this over the next couple of days or the next week, young inexperienced investors
Day
are going to
traders.
panic. Right. They're going to panic when they see the market
and
crash,
you're
particularly because of the geopolitical things now that are going on in the whole world. So we're going to potentially see all this market fluctuation from the Russia-Ukraine situation. Yep. And then you're going to have all these young people that threw maybe $2, $3, $5,000 into the market. Mm-hmm. And when their values go down dramatically, they're going to pull back, which is going to cause more instability in the market conditions.
It's easy to press the sell button.
Yes.
They don't have any background, but this is where, you got retail money, institutional money. Institutional money's patient, they'll wait, right? They know what's going on. Retail money is reactive. You got to take a look and go deeper in there. And this is where an advisor can be worth its weight in gold to keep your head on straight, to know that there's a path, to know that there's a journey, and put you into products or investments that will help protect you from yourself.
Yeah. Right. Well, it's funny. I'm 59 years old, and I came in here, just freaking out, and I told you, sell everything, Ryan. I'm going back to safe haven, and maybe you got to talk some sense into me today, but I get the jitters.
Yes, but I also look at it and go, this is a great opportunity to buy because we've been riding such a high market for the last 2 years. Yeah, we're going to feel this, whether it's a 401k, mutual fund, stocks, when you look at just a 401k alone, a lot of people will say, well, I'm not in the stock market. Well,
yeah, you are.
You are. If you have a pension plan, you're in the stock market. If you have a 401k, you are in the stock market. If you have a 403b with your employer, you are in the stock market. So, a good majority of U.S. consumers are in the stock market in some way, shape, or fashion. So when people get their next quarterly statements, they're going to go, oh my gosh, what happened?
Exactly.
So yeah, I look at it, hey, this is an opportunity potentially to buy and, and not sell like back, you hate to say in the last, obviously the Great Recession of 2008, there were a lot of us that had no option. Our portfolios went down 50% or better. Mm-hmm. We had no option to get through those tough times without selling. But I remembered that point in watching the market recover going, my gosh, if I didn't have to liquidate that, where would I have been today if I could have hung on?
Well, my thought was, and my thought coming in here, and I was talking to my wife this morning to say, you know what? Let's go in the safe haven. Let's sell some of these stocks because we're at a high risk factor, and we can talk about that. And I thought, let's go back in the safe haven, and then we're sitting on some cash and waiting for the market to come down further and then jump in. Is what I thought, but I just don't want to take any more losses. Personally, I think it's going to go down further, and you're the one that has to talk me off that bridge.
That's my job.
But I want to go back a little bit here about financial planning. Okay. I didn't get a financial planner until I was in my 40s. My father was a GM guy, retiree, pension, 401k, self-manage all his money, and then what had happened, I had a customer come in for a mortgage, and I was looking at his asset statements, and I said, oh, wow, there's an annuity, Oh, that's doing pretty good. He goes, oh, yeah, you ought to go see my boys. It was Ryan, it was you and your father, I said, oh, that's cool. No, yeah, no problem. Great, right? Well, the next year he comes back. Now he's helping his son buy a house. And I go, hey, I need your income and asset documents. So he brings me in that annuity statement. I go, boy, that thing's pretty good. He goes, I'm telling you, go see my boy Ryan. They're doing pretty good. I go, yeah, all right. Get out of here, right? The following year he comes back and he's refinancing his house and he brings in a statement. It's that same annuity. And he goes, go see my boy Ryan. So that's when I called.
And it took you 3 years to beat you over the head?
Well, because my father was against a financial planner because he said, you never take financial advice from a working man, which actually made sense. If you were that good at financial planning, you'd be retired, But a lot of us are not. But I was a product of my environment, and I only knew what my father knew. And when I went to you guys, this is your lane. I do mortgages, you guys do financial planning. So I had met with Ryan. We brought Maya in, my wife Maya in there, and he goes, okay, let's take a look at your situation. He goes, okay, well, first thing I'm going to ask you, how much money you got put away for emergency fund? Mm-hmm. And I said, well, I got this. And he said, well, based off your lifestyle, that's not enough. And And you said, well, Vic, I'd love to work with you, but I'm not going to work with you until you create that emergency fund. And you wanted 10 months in that emergency fund. I said, okay. So I went back and we started putting away. And then I call you, I don't know, about 10 months later or something like that. And I go, hey, Ryan, I got my emergency account, man. Come on, man. Take my money. Tell me how to be a billionaire here somehow, right? He goes, well, Vic, I can't take your money yet. He goes, you got life insurance? I said, no. And I go, well, he goes, well, first you got to protect your family. You got to have your reserve accounts and you got to protect your family. So you worked with me on getting a life insurance policy and then got the life insurance policy. Now you said, okay, finally come on in and said, okay, now you got them emergency funds. Where are we going to put those? Blah, blah, blah. But talk a little bit about that when you take a client on and what you look at and what direction you give.
Yeah. And just talking about generalities, and it differs for someone like Daniel. We were talking about your son before he started. He's 19 years old. He's Superman, just getting started with life. And Vic, you're heading into your retirement years, and it can vary a little bit with income and things like that and where you're at stage of life. And, we'll talk about life insurance real quick. As you can see, I'm in a sling right now. I'm no longer Superman, right? Like I was when I was 25. Well, when I was 25 years old, I bought a 30-year term policy, $1 million, to make sure that for the rest of my life, this is before I even got married. This is before I had children. My dad's like, go get the biggest life insurance policy you can afford while you're young and dumb and Superman, right?
Yeah.
And I remember writing that first check and I was like, man, I could do a lot of cool stuff with all this money. But now it's like a trip to dang Costco, for the amount of money and protection I have. But it gives me a peace of mind that, if something happens to Ryan, my wife's taken care of, the mortgage is paid for, all my kids are going to college for a very minimum outlay. So like younger clients, you want to get those. That's an opportunity, right? When you're younger, right? You get those, lay the groundworks, get the emergency fund. But then you switch over to someone like you, Vic, when you finally came in and we talked about emergency fund, when you're well established, right? You're in your high earning careers. But at the same time, if something were to happen to you and you're off work for a year and you've already established this lifestyle with everything else you got going on and expectations, and your wife says, hey, Vic, something happened to you. Yeah. We need to be able to pay these bills.
Yeah, she's going to need another boyfriend.
Yeah. I mean, like him and his wife are a nice balance to risk reward, as I like to say. Yeah. So they tend each other well. But the point being there is that you first got to look at your risk management, and then you start building from there. So many people want to come in guns blazing and want to just, hey, what's the next hot stock that I need to buy so I can be a millionaire in a second, right? It doesn't work. You got to work your way up to that level, and then you can have what I call your fun money, and then you can start playing around. So, back in the day when Ford was $1, you could put money on Ford for $1. If it went bust, then so be it. It didn't blow up your entire financial plan, right? But if Ford went from $1 to $25 like it has recently, hey, you might be buying that another Corvette for or something like that,
Yeah.
So
well, and then also you talked about the age difference there. You brought my daughter in, right?
Yeah.
She's 24 years old, and she goes, Dad, I don't got any money. Why should I see a financial planner? I go, just go talk to him.
Yeah.
And so what do you do with a 24-year-old coming in out of college? What kind of advice would you give someone like that? What do you review?
Yeah. And then just like, everybody, you start with that risk management, those emergency funds, and then take a look what they're offering at work and get them to start saving. Just do something.
Set it and forget it.
Not so much forget it, but just set the saving and, hold your nose in times of bad times. When there's blood in the street, buy. There's a lot of blood in the street right now. It's a buying opportunity in the long term. Now, someone who was maybe 1 to 5 years to retirement, I was pounding the table that you need to make moves to protect what it's grown. This is astronomical. Look at the charts. They're just flying, right? And your 401k has never been so big. You've never been this rich in your life. Your house is worth exponential. Your 401k is worth exponential. Protect it. Don't go backwards. And there's ways to do that in this industry that most people don't know. And if you don't talk to someone who knows, then you don't know. You're your own worst enemy, right?
Question for you, because I have a lot of clients that, they'll sell their house and they want to put a real big down payment on a house, or they want to pay it off,
Yep.
And I tell clients, the best advice I can give is whatever you're comfortable with in the morning. You got to live with this, not me. And even on my own personal situation, Ryan, I said, I just want to go pay my house off, man. I just don't like that payment. But he said, don't do it. Let your money work for you. Can you talk a little bit about on that philosophy and what kind of questions and answers you get on it?
Yeah, I mean, it's a nice tie-in. So like what you guys do, the mortgage, I mean, would you agree or not that if you look from a grand big scheme that we're in very low interest rate environment for mortgages.
Yeah, the average interest rate in the last 50 years on a 30-year mortgage is about 8.5.
8.5.
We have been under 4.5 for pretty much the last 2+ years.
Yeah.
Right. And then, so on that note, if you go back 100 years in the stock market, let's say, you can average between 8 and 10% annualized. So if your mortgage is only 4 and you've got an opportunity to make 10 to 12 over 100 years over time, it still makes more sense to keep your money working and chip off that to pay for the mortgage than it does to pay off something at 4%. Now, if we were back in 1984 when you had mortgage rates of 13 to 15%.
18%.
Yeah, 13 to 18.
That's more than what I can say the market would give you over time. So it makes more sense to pay off something with such a higher interest, right?
So is one of your suggestions that in this still low rate environment, that if someone was to have a bunch of money, maybe do not pay down the mortgage, but because once they pay down that mortgage or give it to the mortgage company, those dollars never work for you again, is invest them with a financial planner and then start shaving some of the sprinkles or some of the profits off that to pay down the mortgage?
Yeah, take a bite. Let it do its thing. Let it sit or let's manage it, because, the market can ebbs and flows, right? But over time, historically, 100% of the time, the markets have reached its previous high water mark. Mm-hmm. That's a stat right now. So right now is a good opportunity, in my opinion. The market's off 10%. So is it going to be a week, a month, 6 months, a year, 5 years from now? The market will reach its previous high water mark. And if you go put that on a house or put it on a car, a car, that's a depreciating asset, right? Then you take that money and it's gone. It's lost. You got to be careful.
Well, one of the questions that Vic and I get daily from home buyers that have a house to sell and a house to buy is, how do we make this transition in this challenging market where you cannot write an offer contingent upon the sale of your home? So we have a lot of clients that will request that we pre-approve them prior to selling the existing home. In fact, I did this with both of my older daughters in the last year that decided to sell their first home and buy their next home. And I knew that they were not going to be competitive in this market if we had to wait contingent upon the sale of their home. So we structured their pre-approval based on less than 20% down. And they were second-time buyers. They really didn't have 20% down. But we looked at it strategically. And I said, look, do 5 or 10% down is a better long-term investment, because we're going to be borrowing money really cheap.
Yep.
And then when you sell your home, then I want you to, make sure that you're in the very best position possible. Because if the payment difference in the mortgage from even 10 to 20% down. Now, ultimately, if you have enough assets and want to put 20% down, not have PMI, of course that makes sense. But I really think it depends on somebody's age. I've also taken people that are in those early retirement years and said, well, again, don't put the whole nest egg on the house. Mm-hmm. You've got to look at the bigger picture. What if your retirement income is going to be taxed? We have people right now, particularly the baby boomer generation, that are going to be taxed higher by the IRS when they're retired than they ever were taxed as a working adult. Exactly. So you go, look, that mortgage can be a tool. Mm-hmm. The mortgage can be a tool to take you from your first house to your second house, of course, but how much you choose to put down. It can be a tool to take you in that downsizing mode. Maybe a small, reasonable mortgage makes sense for somebody that's even in the pre-retirement years if it helps shelter their taxable assets from being liquidated. And again, that is kind of big picture planning, but I'll have clients tell me, well, Danielle, I want to be debt free. I said, well, do you want to be debt free or do you want to be financially independent? Right. Is the way I look at it. I don't want you to have revolving credit card debt.
Right.
You can also live without car payments if you get to that point in life, right? And sure, you could live without a mortgage. We don't want student loans. Those are all the debts that you've got to sometimes take on when you're young, get life started, work on it, get them paid off. as quickly as possible. But financial independence does not mean being entirely debt free. It doesn't mean not having a mortgage. I have seen people that have no debt, but also no financial security. How many times, Vic, over the years, have we seen someone in their early retirement years trying to transition, right, to maybe it's Social Security, maybe it's a small pension, but they have no liquid assets and they can't afford to maintain the house that they want to stay in.
Yep.
They can't put a roof on it.
Or they may not even own a home. They rent it because they were so conservative. You know, they paid off all their debt, rented, and now they come out with just Social Security and they have no assets.
Right. They're not going to live comfortably, not in this inflationary market that we are in and we will continue to, unfortunately, be in for a few years. So, you know, again, I look at it and go, I would rather, and I took the advice from my financial advisor too, because while I own several properties and I've refinanced them all in the last couple of years, put them in the best position, and I really wanted to get 15-year mortgages. I mean, my personal goal is to have all my real estate paid off in the next 15 years before I retire. And I said, do I go for the 30 or do I just bite it and do the 15? You know, I can afford it. And he goes, Danielle, you know the answer to that. He goes, stick with the 30, invest your money and let it grow. So my plan is, yes, I want to pay my mortgages off in 15 years, but I'm going to let my money work for me outside of the mortgage umbrella because it's the only tax deduction I got left. And then be able to say, you know what, I am financially liquid so that I can write a check and pay off those mortgages whenever I want. Then in tight times, I'm financially liquid and I can go to my assets to pay something off, right? I have a lot of clients that I've had first-time buyers ask about 15-year mortgages. Now, nobody ever takes them because they look at that payment and go, ooh, that's too much. Well, it is. But if you worry about making a 15-year mortgage payment, particularly if you're in your 20s or 30s, and don't have anything to fall back on, what are you going to do when tight times happen? Exactly. What are you going to do when you need shoulder surgery? Now, luckily for you, Ryan, you can continue to work after having shoulder surgery. You know, Vic and I could potentially continue to work having a physical limitation, but there could be a lot of health problems. You could have a health problem with a spouse or a child or your parent. Vic and I are at that age where, you know, we're dealing with our parents becoming ill and passing away and needing to move in assisted living and all of these things in life that, you know, guess what? We wouldn't have thought about this 20 years ago.
And it's coming to everybody.
And it's coming.
Yeah.
And if you don't, I mean, I always get up, and I've Vic's seen it before. I draw your life 0 to 100. It's a curve, right?
Yeah.
You're climbing, accumulating, and then you get to the top, which I usually use like your full Social Security age, which is like 67.
Yeah.
It's usually the top. Your accumulation years and then those distribution years.
Yeah.
You got to plan through your accumulation to get ready for the distribution years because you're right. You're one phone call away from a bad thing happening.
Right.
Well,
And not to be pessimistic, but you know, life happens and you need to prepare for that. Yeah. No one has ever called me and said, Danielle, I'm not happy with my decision to take a 30-year mortgage. I wish I would have done a 15. But I have had clients in their peak earning years, particularly back in that 08, 09, call me and go, Danielle, we took a 15-year mortgage and my husband just lost his job. Yeah. And I'm don't make enough money to support the household on a 15-year mortgage. You know, play it safe. Yeah. Stick with the 30. Yeah, you could pay a little bit extra, but I would rather you save for yourself, truly focus on financial independence, Absolutely. Not just being debt free.
And on your client there, sure, Mr. First Time Home Buyer, you want to go to a 15-year, that's fine. Let's mentally think that. Mm-hmm. Let's go to the 30-year amortization, and that 35% difference in payment, invest that with a financial planner to start putting away for emergency accounts, because these first timers on a 15-year, a lot of them don't have any cash once we go to the closing table. There are no emergency funds for life-changing events.
The roof, the water heater, somebody loses a job, you know, and it's prepare for the worst and work hard your whole life. And, you know, for most people it works out, but you better surround yourself with a team of professionals. You know, I got a call last night from someone that husband's kind of, he retired and went back to work. Sounds like it's a second marriage. Now they're blending, you know, 2 adult households. They're going to buy a new house. The husband's already sold his house. Wife's still got a house. And she was just beginning that mortgage strategy conversation. And that was what I discussed with her last night. I said, well, this is not just, hey, what's the lowest rate and what are your closing costs? I need to know where you are today, where a little bit of where you came from and where your goals and your future, where you project that to be, so that we can put you in the best situation and help you compete in this crazy real estate market. Because, you know, you just sold 2 houses, right? In a market where our values are, our properties are worth more than they have ever been. Right. I said, it doesn't make sense for you to put, and if you're both still working, it doesn't make sense for you to put 40% down if you, because they're not going to overbuy. You know, most people are pretty dang conservative with what they're trying to buy. We really don't see buyers going, oh, let's max out our buying power on 2 incomes. No, most people are kind of buying on 1.
Right.
And then going, hey, let's live a good life. Let's save. And there's also a lot of people right now that are self-employed or independent contractors. There's been a huge shift of that, I think, over the last 10 or 15 years, but particularly in the last 2 to 5 years, we have more and more people that are independent contractors. Do you know that you could work for Ford or GM and be an independent contractor?
Yep.
You know, that's not uncommon. But those people don't have the benefits. They don't have the 401ks. There is certainly no pension plan when you are self-employed.
You talked about that, because you and I are commissioned employees, we don't have a pension plan. But what about these self-employed, realtors are 1099 employees? Mm-hmm. How would they go about, putting something away for that emergency account? I mean, is it the same as looking at a guy with a W-2, or how does one? Do they come to you for advice on, hey, I'm self-employed, what's the best way to set up a plan? How would you advise on something like that?
Absolutely. I mean, that's where I joke about having the bean counter and the bean maker. This is where a financial advisor and an accountant work well together. Uh-huh. Okay, so we sit down, we take a look at all the accounting and deductions and credits and things that, we're not paying close attention to. But, I have some self-contracted people like that, and take a look at what they can do. Should they do a SEP? Should they do a solo 401k? Different strategies on that. And you can put different amounts of money away in different strategies, or, are they only going to be them forever, or do they want to grow their business and they want more employees? Like, is that the goal? Which route they're going to go. So this, a little advice, just big perspective, is just to have an accountant and a financial advisor, a CPA, chartered financial consultant, working together so that we can figure out what's the absolute best for them.
Okay. Typical, maybe a question. Well, my income fluctuates. Sometimes it's here and sometimes it's not there. How would you deal with something like that? Can you turn on, turn off, or how would you work with a client like that?
Yeah, when someone's income goes up and down, I'd like to just take an average. Okay, let's say, sometimes you make 10,000, then you do this, then you make 1,000. Like, let's say on average you're pulling in 5,000 a month. Let's go like that, because there's stuff in the wings. You got things coming. Let's just go with an average and start basing on that. If their commissions are going up and down like a yo-yo, I mean, it's tough to budget naturally, but you got to just start figuring out what the average is so you can at least guide from there. So like, if someone's bringing in $5,000 a month, well, maybe their emergency fund needs just 6 months right now, and they need to get 30 grand in there. I mean, when you got to start choosing a path to follow, right? And then you can fluctuate a little bit.
Start somewhere and then
you got to
build it from there.
Put that stake in the ground with an intention of what's going to happen.
Okay.
And then,
well, what I'm thinking here is, okay, so I'm new to the financial planning. I come in and see you. Now, I understand there's bonds, there's stocks, there's mutual funds, there's annuities. How does one even determine, like, where do I go? I'm very unknowledgeable. What makes you determine what may be a good fit for somebody?
Sure. Yeah. So one first thing I do is sit down and I figure out clients' matters of importance, right? We take a look at what they want to do, what they're going for, and there's a plethora of investment choices. And then after that, use a software called Riskalyze. Okay. So Riskalyze is going to help me determine what type of a risk taker you are. Kind of like when you go to the doctor, what's the first thing they do? They put that blood pressure cuff on you to see how the old ticker's doing. Doesn't matter if you have sniffles or you're dying from a gunshot. They're going to still figure out what type of person you are. And I got to figure out what type of risk taker you are. So ultimately, we go through a questionnaire, get to know them a little bit more, and they'll fall between 1 and 99. And I joke with them. I say, if you're very conservative, then we're going to go this path to get to your goal. If you're very aggressive, then we're going to go this path to get to where we need to go. But it all comes down to you and your comfort level. Just like you were talking about, hey, Mr. Mortgage Guy, you want to pay off that loan. If that makes you sleep well at night, then that's what you wanted to do ultimately, right? Even though maybe it doesn't make the most sense, but at the end of the day, it's their money. They're going to do what they're going to do. But, going through that risk-alize analysis will at least help me determine if you're a stock guy, a bond guy, an annuity guy.
And now, and talk about the risk levels between a stock, an annuity, a mutual fund. Explain that to our consumer.
Sure. So simplicity, and I think I've used this analogy for you. The S&P 500 is an index, right? A U.S. index that it tracks. And if you were to put a score on the S&P 500, you would have around 72 to 75. Let's call it 75 for simplicity.
And what does that mean?
It means if the market is giving you around 10% return and your portfolio, when we plug it in, is a 75, you should expect that you're going to get around a 10% return for your portfolio. If it's a 75 and you're only getting 3% return, well, then you're not doing a very good job actually picking investment choices for this client, right? But if you score out to be a 30 and the market's doing 10, well, then you should be happy earning 3 or 4% because you came to us saying you weren't willing to take on the same risk of the market.
Oh, because I was a 30. That's a low conservative versus like a 75 or an 85, which is a very high risk tolerance.
Well,
it's like buying lottery tickets.
Yeah, you want that
versus
roller coaster,
going to a savings account.
You want that roller coaster ride of Wall Street.
Well, I want my cake and eat it too, though.
Well, yeah, so do I, And I joke, I was at Oakland University, and at the end of there, I raised my hand. I said, okay, we got all these designations now, and how about the crystal ball? When am I going to get that? And he said, son.
Oh, that's over at the mortgage company.
Yeah, go see Victor Bale. He'll tell you what to do. No, but he looked at me and said, son, if I had a crystal ball, I wouldn't be here teaching you.
Yeah.
The analogy there is that nobody can predict the future, but what we can do is take a look at the risk involved in the path and different choices. And as you know, Vic, we have different goals and dreams. Like we have the G money, the L money, the F money, risk management. I try to keep things simple. I think it just helps people understand concepts.
Okay, so a stock is the highest risk. Explain what a stock is versus a mutual fund versus an annuity, please.
Sure. So let's just use, we'll talk about technology. So Apple, for example, you can go out and buy Apple stock, right? And that's an individual company and you hold a share, you are technically a share owner of Apple. And that's going to have a risk probably around 85 to 90, 95, right? Because it's not diversified at all. You're in it to win it with Apple. You got that ticket, right? Then you can go into a mutual fund that might be a technology mutual fund that's going to hold like Apple, Nvidia, Microsoft, like that, or an ETF, same thing like an XLK, a technology ETF that's going to hold a whole bunch of companies. So you're not just holding Apple, you're holding a whole bunch of companies like in a certain sector. So you want to play all of them.
And for our consumers, so if I buy one share of stock and it could go up or down very quickly.
Correct.
But if I buy a mutual fund, that mutual fund holds shares of different technology stocks or whatever sector I'm in. Mm-hmm. And one could fluctuate or two, but it's kind of an average fluctuation of all three put together then, or how many?
And it's going to be more diversified. So they probably heard the thing, don't put all your eggs in one basket.
Okay.
Buying one share of Apple, that's putting all your eggs in one basket. Buying a diversified ETF or mutual fund, it's not going to just blow up because of one bad earnings report from a company.
Okay, now explain to us, what is an annuity?
What is an annuity?
Yes.
There's different annuities out there.
Because I hear, stay away from annuities. Go to annuities. Stay away. There's ifs, ands, or buts about it.
You got fixed annuities, you got equity index annuities, you got variable annuities. Each one of these has different risk rewards inside of them. But ultimately, it's a risk transference vehicle. That's really what it is. So I simply say, Vic, do you buy homeowners insurance? Yes, I do. Do you have car insurance? Yes, I do. Well, why do you do that? Well, in case my house burns down, then the insurance company is going to rebuild it for me, right? And do you like writing that check? No, but if the house burns down, you'd be so thankful that you wrote that check, right? Putting some of your money into an annuity is protecting you from the financial house burning down.
Right. And this was the conversation I had with you a couple of weeks ago because I was questioning, hey, aren't these fees on these annuities a little too high? And your response to that was what?
Yeah. guarantees have fees.
Guarantees have fees.
Yes, in this industry. I mean, if you just want to have a portfolio of stocks and bonds and mutual funds, there's no guarantees. If that piggy bank runs out, if Russia invades Ukraine and this all goes to hell in a handbasket, then you're done. You're out.
And how does the safety of an annuity work for a client under this situation where the market's fluctuating?
Oh, the peace of mind knowing that the protection's there.
What is the protection of annuities? So our people understand.
Well, there's different types of protection. There's the standard death benefit, where if you put in $100,000, the market goes down to 50, and then all of a sudden you pass away, your loved ones are going to get that 100,000 back.
Okay.
So they're going to get a return of premium. That's a nice feature of some of these annuities out there. There's also the living benefit riders that you can add on. It's kind of like putting the cherry on top of a sundae, right? To know that you can have income for life, even if your proverbial piggy bank runs out.
So let me try to put that in English a little bit. So I put $100,000 into annuity, and there's $100,000 in there. And then once I turn 59 and a half, I can start drawing income off that for life. But if the stock market went down to zero and my annuity went down to zero, I still have that guaranteed $100,000 for life.
That's part of the insurance. Yep.
Okay. With the death benefit.
Yep. You're putting the death benefit in there for your loved ones.
Wow, that's pretty interesting there. And so do you, most clients have, do you work with clients that just play the stock markets, like rolling dice, or do you try to mix everybody up into a balanced portfolio, or how do you determine that?
I mean, like I've said before, we have guaranteed money, which is things like your pension, Social Security, annuities. You know, guarantees is a big word in my industry. To be saying, hey, I guarantee Ford Motor Company's go to $100 a share. No, you're going to be suing me my butt off, you know. But I can at least back it up with guarantees through annuities, through the contracts that you sign and the companies you're with, to make sure that that money keeps coming in. So we have things like guaranteed money. Then we have liquid money, which is more, you know, a diversified portfolio that you can pull from. So if that classic car you always wanted comes up and it's 25 grand, well, you certainly aren't going to Social Security and getting a loan for $25,000. They can barely pay you your monthly amount that they're giving it to you. So you need to have some liquid money and diversification for those hard times. And on top of that, the fun money, the stocks. Yeah, there's definitely a lot of clients that say, hey, I would like to buy this one company, put it all on there. I'm willing to take on that risk. But they know that we already have a plan in place that if that one company goes bust, they're not going to be a greeter at Walmart because their whole financial plan just went kaput.
So that's the top of the pyramid. It's to play money.
It is. But you got to get there.
You build it. Exactly. Well, you're not going to necessarily start there in your early 20s when you're getting out of college or just starting a career or trade or whatever. You've got to, it's a progression. You got to start somewhere. And then over time, you build it and go from there. You know. And I think, and this would be it's like your dad's comments and thoughts, Vic, that, you know what, you don't trust somebody with your money. And just like there's good loan officers out there and there's bad loan officers out there, there's good financial advisors and there's probably not good financial advisors.
Every industry has it.
Exactly. So, you know, to go with a trusted referral from someone that you know is knowledgeable, trustworthy, you know, that's what I think is really cool with, you know, your history with your father's history. I mean, you've basically built a family business and a practice and obviously have done so with the highest of integrity.
Yeah. And it's our business is relationships. I mean, it's not transactions. I mean, you got to trust that they're in their best interest at all time. I mean, like I joke, we don't have a crystal ball, but we're out there doing the research, doing the knowledge, talking to many different talking heads and figuring out the best strategy going forward for these clients. You know, it's not, hey, here's my money, see you later, I'm out of here. For us, it's a relationship. Come in, sit down, get to know each other, watch these kids and clients grow. Like your daughters and your son, they're just getting started. It's going to be fun. Yeah. Or working with you and then seeing, you know, your father passed away recently. So that opens up a whole new cans of worms for financial planning. Yeah. And that's the biggest thing out there is, you know, this generational wealth is going to be passed down. And then your baby boomers are exiting the workforce left and right. And COVID has pushed them through there. I mean, they've lost loved ones. I mean, I've seen clients pass away at 56 years old from COVID, you know, 60 years old, people that we would plan for the long term, and they're no longer here. And that just changes everything.
I got a question. So as clients get into their, let's say, close to retirement years, you know, 5-6 years out, do you also help strategize for tax planning and move buckets of money around into different stuff to help them prepare for that? Or How do you go about that?
To a certain degree, yeah. We take a look and, there's different buckets of money. You have your qualified money that's like in your 401k, non-qualified money that you saved from after-tax money that you put into, say, like a brokerage account, something like that. And then you have different buckets of money that you can pull from. And then really when it comes to actually retiring is where to pull from the money from. So like, for example, let's say all of a sudden taxes go up, right? Where all of a sudden for a new regime comes in and we have taxes going up on your ordinary income tax. Well, maybe it makes sense to start pulling money from your Roth IRA money where you're not paying taxes for a while. And then another 4 years goes by, the regime comes in, cuts tax back, and then we can go back into your ordinary income tax, But if all you have is ordinary income tax and you can only pull from one bucket, I can't do anything about that because that's what they told you to do in your 401k, save tax deferred, and then you have to pay an ordinary income tax later.
And you're going to pay tax no matter what.
I can't avoid it.
No matter what.
If you're a U.S. citizen, you're going to have to pay taxes at some point. You just know it. And that's a risk, right? So like if clients have $1 million in their 401k and it's all tax deferred and all of a sudden taxes go from 22% to 50%, well, really you only got like 500,000 because every dollar you got to take out, you got to give Uncle Sam 50 cents. So
okay,
that's
so now,
tough.
so when people have these non-qualified accounts where they're going to pay tax on this money, do you ever advise them to say, hey, let's start pulling out of that now? Because is it wise to take out like, for example, I've got an IRA. Should I be pulling money out of that now and paying the taxes and dumping that into a Roth or some other annuity? Or no?
And that's where you got to take a look at everything. Different wage earners, how much money did you make that year? Does it make strategy? Does it make sense at that moment where the market's at? There's a lot to that conversation than just simple, here's boom.
But I'm in my income earning years, so to me, it just makes sense that, don't take any money until I'm not making any income. Then what I do take to live on, I'm only paying tax on that, not that plus my earned income.
Exactly.
Right.
And
I see.
I mean, and everybody's an individual case. If you know that you're going to exit strategy at this time and date, then we can plan for that. But if the rules that we have to live by, aka the IRS comes in and everything changes, well, we were planning for this. Now we have to go from another route. We can't control if they come in and change those taxes.
Okay. Let me ask you this. So when a client calls and they want an initial consultation, one, how long does it take? And is there any cost to this? What happens there?
No. So for example, if you recommend somebody, Vic, and we know it's a good recommended source, we don't charge anything.
Okay.
Sometimes we'll charge $1,000 to $1,500 depending on how much planning. But if it's a good client, we will just waive it with good faith that we're going to be doing business with each other, right? And we have a good feeling for it. So they come in. It can be a Zoom call. It can be Microsoft Teams. It can be an in-person. Everybody's all over the map with COVID, and it's been more accepted to do a Zoom call. Such a digital interchange that people have, and they come in. We sit down, and like I said, we do the matters of importance. We ask them to bring a whole bunch of first appointment checklist materials, and I call them my financial puzzle pieces, so I can kind of get to know you, get to know what you got to work with, and then start taking it so we can start building it. You come and tell me your matters of importance. Give me your financial puzzle pieces. We'll start building a vision for you to actually achieve it.
Okay, you talked about building a vision, obviously, because there must be some software. How long does it take you guys to build this vision out on all these modeling tools that you have?
Sure. So it's like, usually we do it in, depending on client, a 2 to 3 step process, right? Okay. First, we establish who you are, gather the information, figure out what you want to do. Then we analyze it, develop a plan, and put it together, and then we present it to the client, step 2. And then at that point, we talk about what's going on, and if they want to implement or monitor the plan, that's step 3, right? So it's a 2 to 3 step process. Some clients are gung-ho, they want to get things going fast, and some want to slow play it and read it and digest it before they actually implement it. And everybody's, we got to go at their speed, right? So usually it's a 3-step process to make sure that we know everything about the client. So we're giving their proper advice to make sure that we understand who they are and what they're looking for and how we're going to play the field with what their goals and dreams are. And, I joke, football analogy, right? You got the Detroit Lions that play on the same field as the New England Patriots, right? The Patriots have all these Super Bowls, the Lions have none.
Right.
So you got to be careful what team you join. You're right, because the field,
Well, who the coaches.
the field is the stock market, right? You're only going to get what you can get. Just like in your guys' realm, interest rates are interest rates, right? How much can you guys control that?
Not at all.
Not at all, right? So you got to be careful who you're working with. And then, little advice is go in there and, if you go to someone's website, you'll see a FINRA broker check. Go on there, click on that. It takes you right to FINRA. You can look at the history of
Wait a minute,
the
hold
advisor.
on. Wait, back up. So what is that again? Explain that a little slower so I can go figure this out. Now, what do I got to look for?
Yeah. So, for example, type in www.gr8lakes financial.com.
Great
Go to our
Lakes
website.
Financial. Okay.
In the homepage, if you are a licensed security advisor, the bottom right will be a FINRA broker check.
Okay.
Click on that. Type in the last name of the person that you were looking at, Schacht, SCHACHT, 48116, Brighton. Click on it, and it'll pull up my name. You can go in there, look at my history, look at how many licenses I have.
Oh, your little report card, a little bad. See if you're on the red list.
Exactly. Well, that helps. That helps with people when they evaluate who they're going to work with. Because even locally, you can have a life insurance license around here and call yourself a financial advisor. So just be careful who you choose to take advice from.
Okay, so now once a client becomes a client, how often you check in with them and make sure that you're on plan, on goal?
Sure. So in the beginning, I joke with them, it's like dating, right? We're talking to each other a lot. We're really figuring out our goals and dreams together, how we're going to do this together. So when we go through that first 3-step process, it's a lot of touches, a lot of talking and things like that. But then we start getting a little bit more comfortable. We'll bring you in for 6 months to see how it's going. How's it feeling? Do you have any questions of what you're in, what's going on, and maybe an update on the market? Then we'll bring them in another 6 months for the 1 year mark. And then, unless things are really changing in their life, then really we need to do at least an annual review. But I always tell them, we're just one phone call, a text, an email away at the drop of a bucket if something changes in your life. Right. If you get that proverbial phone call that dad just passed away, well, geez, you need to get in. We need to plan, schedule a time with the staff, get in here. Let's start planning, because that path that we chose is now changed. Right. So you gotta get on it. And then it's up to us. Great Lakes Financial Services uses a lighthouse, right? We use that lighthouse analogy. Why do you use a lighthouse? Because when the storms are churning, you're looking for that guidance, right? Come in or stay out, and that's where we're going to be there when the storm comes a hitting. Right now, the storm's coming, and we need to figure out what we're going to do.
Okay, good. Okay, so we're going to wrap up the show now, and I just want you, if you could, just give us your name, the best phone number, and your website, if people want to get a hold of you.
Sure. Yeah. So I'm Ryan Schacht, Great Lakes Financial Services in Brighton, Michigan, 48116. My phone number is 810-229-4170. Our website is www.gr8lakesfinancial.com. I know it's a mouthful, but it's greatlakesfinancial.com. And you can go in there. We have videos. You can learn a little bit more about me, learn more about our business, and there's a lot of good videos in there that you can check it out.
Well, thank you very much. Danielle, any closing words for today?
Thank you, Ryan. It was a pleasure meeting you, and very informative. So keep your pulse on the market, and keep us posted. It's going to be an interesting, rocky road.
Yeah, we're going to see some volatility here coming up pretty soon.
I've been telling people put on your volatility pants, because it's here for a while.
Yeah.
Okay, everybody. Well, that wraps up this week's show. That was pretty interesting. And that was Danielle Boote. I'm Victor Bals. We will see you next time here on A Smarter Way Home.